Are you tired of taking trades at random, willy-nilly, and trading off vibes, trading off feeling, trading off reaction to the market? Well, I'm going to be showing you how to build a trading system from the ground up, step by step, so you can stop gambling and trading with purpose. There are some instances where traders do have that feel and they do pretty well at certain points, then everything combusts. We want to X that and break down how to build out a trading strategy with the influence of how I've built mine, step by step throughout a 3-part course video, and this is going to be part 1. We're going to start with the basics and we're going to dive right into this after this intro. So like I said, this is going to be part 1. We're going to understand the basics of what a real trading strategy is all about before we start getting into video 2 and video 3, which are going to come along right after this in the following weeks. So before we start, there are some things that every trader really needs to understand to effectively build out a trading strategy and trade with it. Number 1, right, the expectancy of a very high win rate. Traders look at trading strategies and they think that in a long term, they're going to be finding 80% win rates, 90% win rates, and when they see a few losses, they get discouraged by the trading strategy and start hopping around, right? Some of the best traders I know have between a 30 and a 60% profitability, right? So if you're hitting above that, I think you're doing extremely well, especially on the long run. The other thing is accepting risk and managing it is as vital as having a trading system with positive expectancy. Realistically, I don't think you can trade without both of these put together. And number 3, the key holy grail to trading is, that's right, having an edge in the markets that gives you a statistical advantage, not the perfect strategy. I know several profitable, highly successful traders, and they have all one thing in common. Not that they're trading the same way or the same strategy, but they keep their strategy very simple. This is what I'm going to be showing you throughout these coming 3 videos and how to develop a simple strategy while we take influence from mine. So first and foremost, the core strategy framework. Before you even touch a chart, we have to get the architecture right. We're going to be talking about the trader's identity. We're going to be talking about choosing your market, and we're going to be talking about different strategy types. These are very, very important factors in understanding the general framework of strategy building. So first and foremost, before you even start, you have to understand your trader identity. There are 2 general paths, especially in the futures market, in any market realistically, day trading or swing trading. In day trading, there are other several categories like intraday traders that look for larger positions and larger moves, or just scalpers, right? Swing trading is very self-explanatory. You're holding for over a day realistically. Now, swing trading in futures is a little less common, but before you start, you need to decide what kind of trader you are, and those are the general 2 options. For most people, this is dictated by many aspects of life. Your time limitations, are you able to watch the screen during specific times, or even maybe for a few hours, or can you watch it whenever you want? So there are advantages to both swing trading and day trading. Day traders usually focus to 1 to 3 maybe markets at a time, while swing traders do have a wider pool to cast their net. So realistically, if you have more time to spend in front of the computers, you can push yourself more towards the day trading aspect where you can look for intraday trades, even scalps. You have more flexibility. Day trading does tend to be a little more straightforward and technical. You have less markets to gawk at in a sense, and if you follow your system, you limit your mistakes, you can succeed and do well. But you do need to be very accurate in the heat of the moment, and markets do move faster. It's a harder endeavor that requires 100% focus and making very quick decisions, and mistakes can be very costly to your account and your mental state, right? In day trading, things happen very fast. At the click of a button, you can be in trades in the second, in the millisecond, and a lot of the times people let that really take control, especially in a series of losses or one loss that triggers that mental state, which can be extremely costly. Now, day trading tends to play on traders' emotions a lot more than swing trading, and swing trading can be a little more forgiving because you're dealing with wider stops. You have a lot more time, you have hours to actually place your trade, decide if you want to stay in the trade, and then you have days to decide what to do afterwards in general. Swing trading futures does require a lot more capital and the risk is higher. Now the thing is, you can't necessarily copy someone else's plan if it doesn't fit you. You can get influence from other traders that do well, and you can take their trades, their system, reverse engineer it, and really understand. The whole point of building a strategy is creating something that's repeatable, that has positive expectancy, that can deliver an edge, and most importantly, something that you fully understand in and out. Now, the second part is choosing your market, right? As a trader, you want to understand what it is in and out that you're actually trading. Now, why futures? There are plenty of markets out there that we've covered in previous videos. We've covered why futures has a lot of advantages over other assets, specifically in day trading. And day trading requires liquid markets that have solid movement throughout the day, meaning a lot of opportunity. They help with higher leverage, right? You want to look at standardized instruments where you can see the volume, and among other things, right, you want things to be centralized just for that same reason. This is where futures markets do come into play. There are still many choices within the futures market, and there are other markets out there that have created many successful traders. No matter which market you choose, you need to know the market in and out. So you want to consider the following, right? What are the most active and volatile hours of the market that you're trading? What news influences the given market? It's a very important aspect, especially with the recent tape bombs that we have with the new government in the US. Now, what are the trading hours? What are the market hours of the asset that you're trading, right? Are they 24 hours? When do they close? All very important aspects. What market participants mainly move the markets, right? Is it a flurry of institutional traders? Is it big size? Is it a lot of spoofing, right? What's the case here? What are the main correlations within the market is another very important question, and how liquid is your market? That's why the futures market sticks out, because these are very easy questions to answer. You also have to understand the products within the market that you're trading. Which products should you trade in the futures market, right? There's a huge list: indices, commodities, softs, bonds, you name it. Regardless, you need to know the product in and out, the margin requirements, the tick value, when it's open, what are the most volatile hours, and who the market participants are, along with the character of each individual market. Not all markets move the same. The principles can apply to several different markets, but each one has a little nuance that you have to be aware of. Now let's take a look at NASDAQ as an example. We have to understand everything about NASDAQ. Its notional value, tick value, right? Time of operation, when it's volatile, the market participants, the general characteristics the market really has. The notional value is a very important aspect. It's the actual size that you control with one singular contract. So if the value of the NASDAQ is 20 times the index, and we assume that the NASDAQ's trading at 22,000 or about, the notional value is $440,000 per contract that you are able to control with X amount of margin. The margin is the dollar requirement that you need in your account to actually be able to trade that one contract. So for example, if we look at a discount broker like AMP Futures, the day trading margin for NASDAQ Futures is $1,000, meaning that with $1,000, you can control one contract on an intraday basis, meaning that you have 440x leverage. The maintenance margin, which is the 1 hour close between 5 p.m. and 6 p.m., to hold one individual contract, you're required about $35,000. With the most recent volatility, it does make a lot of sense. Now, you can cut that in 10 for the micros. Still, it's a very significant amount if you do want to swing trade. Now, the thing is, you have other brokers like Interactive Brokers where the margins are extremely big, right? But that's because they're not discount brokers. Regardless, you need to know what the margins are, what the notional value is, everything. The tick value for NASDAQ, you have $5 a tick, meaning $20 a point of movement if you're trading the minis. When does the market open? When does it operate? It nearly trades 24/6, I guess. There's 1 hour throughout the day between 5 p.m. and 6 p.m. that the markets are closed, and the general hours of most movement are usually during the RTH or the New York session, and there is still movement in the London session, so European traders can trade US equities as well. Market participants, usually very heavy-handed traders, strong-handed traders like institutional traders that reposition, move a lot of size. There are a lot of participants, including retail traders. Now, some of the best futures markets to trade for newer traders are generally equities and commodities. If you're looking at the futures market, some of the most common futures to trade are the S&P 500, the NASDAQ, the Dow Jones, crude oil, and gold. All of these are very liquid. They have several moves throughout the day and through different time zones that allow multiple traders with different walks of life to be able to trade them with liquidity without having to worry that, oh, okay, I'm not going to get filled for a take profit like 10 points away if it trades within that area. Another thing is micros versus minis. This is a very, very common question that a lot of traders ask themselves. They ask other people. Naturally, minis, you can make a lot more money. They're 10 times the size of micros, but what people have to understand is their account sizing and risk. It's something that we'll talk about in another video, but traders should be realistic when developing their strategy. What is your starting point? Realistically, if you have $5,000, $10,000, you should not be trading minis. It can blow out an account very, very easily. Futures have the luxury of offering a smaller product that's 1/10 of the normal size, which, like we said, is called micros. So next up, we got to talk strategy types, right? There are 3 core setups, but they revolve around 2 general market movement ideas. You're either with the trend or you're against the trend. Now, the 3 core setups that fall into these categories are trend trading, right? Trend following. If the market's going up, it's in a bullish trend. You want to continuously try to look for that momentum. The next one is a counter trend setup, which is generally a mean reversion or a fade setup that goes against the current trend momentum, trying to find that reversal. And the last is still a trend following setup, but it's a breakout. It's a more aggressive movement into the trend, following the trend in a more aggressive path, breaking through a top or a bottom. So let's dive into these a little more. We'll use the NASDAQ as our guide here on the screen and get a better breakdown using these range bar charts. We're going to be looking at a few different charts today, but not overcomplicating things. The reason here is we have to understand fully and deeply these 3 core strategies and setups, because generally a lot of traders might lean to one or the other, and they might be very good and at one or the other, or very bad at a lot of them, right? Or whatever the case is, it might be a whole mix-up. So you want to find what's really, really good for you, what sits well with you, what you understand fully, and that's going to be a core part of this trading strategy that you're looking for. So we can delve into them, expand them a little more, but it's important to know how they operate from a technical and from an internal level. So the first one is trend following. It's the easiest I find to understand. Trends are threefold, right? You generally have a downtrend, you have an uptrend, and then you have a range that moves sideways. Very simple. These 2 are considered expansive moves. Trend following suggests that we find a trend and we jump on it, usually either bullish or bearish, but we can consider playing the range for today's example as another option. This is where market participants are heavily weighted on one side, and they continue to push in that direction, right? You'll see volume spikes in that direction and quick reactions to continue their direction if they even pull back. So in this specific example here that you see on the screen with NASDAQ, you have a general uptrend that follows, right? You have incremental higher highs, higher lows, higher highs, higher lows. And if we're looking for the trend following kind of setup, this is something that we'd be interested in. When we break through a high, we pull back into a high. When we break into a high, we pull back into a high. When we break into a high, pull back, and so on and so forth until that fails. So the trend following tool for this bullish momentum is understand that higher highs and higher lows continue the move. And if we want to be a part of that, and it's easier for us to find instead of thinking, oh, it's gone up too much, well, we're going to be looking for general pullbacks to get on side with this overall movement to continue this recent upside move. Now, the next general setup is a mean reversion type trade. So this is a counter trend trade. It is usually called fading when you're going against the trend. This is where you look for the market to get a little more tired, to get a little too far away from its general balance. It looks exhausted, and the potential for new buyers or new sellers to come out just completely fails, and you're looking for a complete reversal. In general, these are harder setups, but traders seem to gravitate towards them because if they miss the first move that might be to the upside or the downside, which is often the case. They usually think that it can't keep going in that direction, and they try to find the reversal, which generally clobbers them. Now, this is why this setup is usually the lowest probability, but it has the best risk to reward realistically, and we can increase its probability by adding parameters. And in fact, this is one of my core setups, and we'll talk a lot about it in the subsequent videos, but mean reversion isn't just about excess. It's about finding traders that are getting trapped, that are getting tired in the direction, that just can't keep pushing. So if we take a look at the current setup here, we have this strong spike that happens that eventually allows prices to turn back around. We have another strong spike that happens that eventually allow traders to turn back around. A lot of traders can look at this from a price action perspective. We can add other parameters. For instance, where prices fail to continuously make new highs, higher lows, and you start breaking back under those rotations, this can trigger that kind of mean reversion for a lot of traders that might be looking at this setup. Another factor here, if we continue this uptrend, but at a certain point, we can't make new highs, we have lower highs incremental, and we start breaking the overall trend. This is where traders look for a mean reversion. This is how Fade's set up. Instead of me trying to look at this and say, oh, this is going to be the top, oh, this is the top, this is the top, this is the top, wait for some kind of break-in structure, and the volume profile is a fantastic tool combined with order flow to find this mean reversion setup. Because you can have very large moves. Even here, when we get overextended to the downside, it reverses. You get overextended to the downside, it reverses. Just like the upside. You can find very, very powerful moves. These are 200-point movers here on the screen on NASDAQ, which is bountiful, especially if you're using 20 to 30 points of risk. Now, this final one is the breakout setup. It too is considered a trend following setup, and in my opinion at least, it's my least favorite. It's one that I do not trade at all because it requires very specific market conditions that don't show up as much. It requires increased volatility, faster moves, larger breaks through key areas that may not happen too often. And trending markets that break through large balances and areas often have limited chances for the breakout. This is usually a strategy that involves maybe an opening a range or even scalping, because in a lot of situations you might be looking for the breakout, it has a little head fake, pulls out, and then the real breakout happens. There is a lot of opportunity in this, but you really need to have more criteria, in my opinion, than some of the other setups that we've talked about. Now, breakout traders, they do extremely well. It's just that something that I haven't mastered, but it is a setup that you might want to consider in your trading strategy. I think that traders generally should be acquainted with all these trade setups so they can hone whichever fits their personality, their setup, their trading style the best, and how they trade in general. You don't want to force something that doesn't fully make sense to you. That's why I don't trade all of these. I don't really trade the breakout. I mainly focus on mean reversions and trend following tools. Now that we understand those trading setups, we want to understand what really makes a strategy. What is a trading strategy? A trading strategy involves naturally the market. We have to understand market context, the setup that we're looking for, the entry, the stop, the target, the rules, the risk management. A strategy realistically is a checklist of waiting for something to set up that has positive expectancy, and we want to remember to keep it simple. That's the main goal. I don't want to look at a messy screen with 1,000 indicators on it. More is not always great, right? Less is more, especially when starting, especially in trading. Now, to get to that point, you want to gather a sample size for your system and the setups that you're trading to understand what you're doing correctly and what you're doing incorrectly, right? Some things may make sense, other things may not make sense, and the things that don't necessarily make sense, you might want to even just leave those out of your strategy. Remember, simple is good, less is more. You want to set up your criteria for everything that you do. The less discretion that you can pile in and still be the operator, the better. Context is a drastically overlooked aspect in trading that will be our main focus in the coming video, but every trader realistically has to understand what it is that they're looking for and when. Now, the most important aspect of your trading strategy is your edge. What makes it repeatable, right? The expectancy is your win rate times your risk to reward minus whatever costs you incur. Without edge, perfect risk management just makes you lose slower. We'll discuss this more in the following parts, but trading edge isn't a strategy. Keep that in mind. It's a repeatable condition or method that gives a statistical advantage in the market over a period of time. It's what makes your strategy profitable. It's the way you enter, maybe exit, your psychology, whatever the case may be, how you actually execute in the market that gives you the upper hand. Next up, we want to talk about basics of strategies that you can start off with. Very basic futures setups. We've talked about the three main core components, but we have to understand that the prime directive is identifying areas that we can trade from. So areas that we can trade from are going to be extremely important in understanding market context as well. So it's not as simple as just like drawing lines on the chart, trend lines, this and that. I think that people should start off with looking at it from a very auction-based perspective, right? There are infinite ways to necessarily develop areas to trade from, support, resistance, but if we think of the market as a two-way auction, then volume is going to be the center of attention in developing this understanding. Think of the volume profile as a visual component of how market participants interact with one another, right? We're going to be looking at low volume and high volume nodes. We're going to be looking at areas of imbalance and balance, and we're looking at how auction market theory generally works. So if the market is a two-way auction, you have market participants on both sides. You have buyers and you have sellers. You have traders that create balance where they think fair value is actually accumulated in the market. And then when different information comes into the market, you have expansions. Generally, this is how the market works, right? Buyers and sellers, they come together to understand that there's going to be a fair value at a certain point where you have a compressive period in prices, right? Generally, these are called balances. Now, markets move based on balances. They move from one balance to another balance, back into the prior balance, developing a new balance later on, so on and so forth. And this cycle continuously repeats. So when we talk about balances, we talk about auctions, two-way auctions. The best way to look at this is a volume profile that I've found. You can generate support and resistance areas by understanding where these balances are in a larger volume profile, and you can use individual volume profiles to develop an understanding where balances are. When we look at the market, low volume areas like this red spot over here are going to be areas where volume drops off, and market participants are going to try to trade against those regions. So we can hone in on support resistance at a very basic point like this. You can look at it from a price action perspective, and the list is limitless. But this is going to be something that we're going to be deep diving in the next video, where we talk everything market context and we start pulling in the simplicities of auction market theory as a philosophy of a trading strategy. So again, 1,000 ways to skin a cat, but I'm going to be showing you how I've developed my trading strategy so that we can look at very key components that allow us to identify these high probability setups that we have shown you guys in several other videos, and we will continue to do so in the coming videos. So remember, strategy. You want to look at your identity as a trader, the market, the setups, risk, and then feedback. That's the general loop that we're going to be going over through this 3-part series. Remember, the holy grail is execution with edge. It's not going to be a simple strategy or whatever the case is. Now, part 2 is coming out, but while you wait for that, we have a link down below for a free PDF that highlights a lot of these components from my specific trading strategy, along with some trading psychology tips that you don't want to miss. And we'll see you guys in the next video. Remember to like and subscribe, and we'll chat soon.